Thanks for taking a look at this video. I'm Stefan Ninsala, Certified Financial Planner, here to help you start building wealth on your path to financial freedom. So in this video, I'm going to talk to you about saving for retirement in your 401k and an IRA, and just give you the distinctions between some of the differences I just want to point out. Saving for retirement is one of the most important financial goals that we need to achieve in our lifetime. The choice of which retirement savings account can help accomplish that goal. Whether it's a 401k, 403b, TSP, or 457 plan offered by an employer, or an individual retirement account, that's IRA, that you established on your own, the benefits of these accounts can help ensure that you'll have enough money to live on in your golden years. In this video, I will discuss some basic rules and account type variations. In the next video, I will discuss investment options with you, but that goes into a little bit more detail. Now, some companies may still offer pensions, but pensions are generally a thing of the past, where employers provided a defined benefit plan or put money aside for the employee to benefit or fund their retirement. Think of government or teachers, they still have pensions, but generally speaking, most companies don't offer that. Now, employers want to give their employees a tax-advantaged way to save for retirement through a defined contribution plan, such as a 401k, in which the employee is responsible to contribute a percentage of their salary into their 401k, while the employer may offer a matching contribution up to a specific limit. Now, rule number one, make sure you contribute at least up to the full company match. Don't leave free money on the table. So for example, if the company will add 100% up to the first 6% that you contribute, then that's an automatic 12% annual contribution collectively. You can always do more. As a matter of fact, up to $20,500 in the year 2022, $19,500 in 2021. If you're under the age of 50. But if you're turning 50 years of age in the given year or older, you can add what's called a catch-up contribution. So that's an additional $6,500. So in 2022, and you're 50 or over, that's a grand total of $27,000 that you can contribute into your employer-sponsored plan. And here's a major benefit in the case of a traditional 401k retirement plan, and you want to reduce your tax liability today. Suppose you're age 35 and single, making $100,000 per year, and you contribute 20% of your income. That's $20,000. And that automatically reduces your taxable income from $100,000 to $80,000. Remember, however, the $20,000 plus additional matching contributions by your employer will build and grow what's called tax deferred until you begin withdrawing the money out as needed in your retirement. Now, those distributions at that later time frame will be taxed as ordinary income. Now, this works the same with the traditional IRA, in which contributions are generally tax deductible depending on your modified adjusted gross income. However, contribution limits are up to only $6,000 with a catch-up contribution limit of $1,000. I want to point out briefly, here's something about a Roth versus traditional. In a Roth IRA, income limits matter. The IRS states if you earn over $140,000 per year, modified adjusted gross income, then you cannot directly contribute into a Roth IRA. However, in a Roth 401k, income does not matter. If you earn $500,000 per year, it's all good. There are some key differences in Roth versus traditional. One reason why people love the Roth is primarily because the earnings made on contributions after having the account established for 5 years, guess what? Is tax-free money. Please note, contributions into the Roth 401k or Roth IRA gets zero tax deduction from your earned income today. So once again, suppose you're age 35 and single, making $100,000 per year, and you contribute 20% of your income, $20,000, into the Roth 401k. That will not reduce your taxable income to $80,000, but remain at $100,000 in this example. But here's why I like the Roth IRA. Number one, although traditionally, if your income needs will be lower in retirement and you assume to be in a lower tax bracket in the future, getting a tax break today and paying lower taxes in the future seems reasonable. However, with all the government spending and so forth, who knows what taxes will be in the future? The Roth gives you tax-free benefit on withdrawals. Number two, when you contribute into a Roth IRA, you must be age 59 and a half, that's considered retirement age, to avoid early withdrawal penalties of 10%. Also, you must have the Roth IRA account established for 5 years, and that begins January 1st in the year you establish a Roth, to have withdrawals tax-free. So let me give you an example. Say you add $3,000 in year one, $4,000 in year two, and another $3,000 in year three. So that's a grand total of $10,000. The account has grown to $15,000 because of the market, in which $10,000 is what's called your cost basis. And the additional $5,000 is your capital gain. But let's just say you have an emergency need and you need to access $5,000 and you decide to withdraw the funds from your Roth IRA. The IRS says, no problem. In the instance of a Roth IRA, the money you have already been taxed on, whether it was after-tax contributions or you had a traditional IRA and you converted it into a Roth, the IRS considers the basis money to be the first money withdrawn, no matter how long you've had the account or how old you are. So a quick rule on the Roth 401k, as that will be determined by your employer's plan rules, so make sure that you reach out to your company. Also, if you've had the Roth 401k for 10 years, then decide to leave your firm and roll over your Roth 401k into a Roth IRA, the 5-year clock starts all over again. So the 10 years that you had in the beginning, the 10 years that you've been putting into the Roth 401k, it doesn't give you that 5-year benefit. So therefore, I suggest opening a Roth IRA as soon as possible to begin your 5-year window prior. So in conclusion, when you have a traditional 401k, a Roth 401k, and the amount that you can put in, clearly the IRS allows you to put in more of your income than into an IRA. However, there are more flexibility options that are in a retirement account that's personally yours, an IRA, an individual retirement account, than say with what your company has. Some companies may allow you to invest in individual stocks, but most, they just have what are called mutual funds or exchange traded funds, ETFs. In that case, you'll have a fund manager that what they'll do is they'll buy the stocks or bonds, depending on the risk that they want to have in that particular mutual fund or ETF, and then you can go ahead and put your investments that way. Stay tuned for another video where I'll be talking more about specific investment options through the stock market and also real estate. This is Stefan Ninsala, once again, certified financial planner, here to help you on your pathway to financial freedom and building wealth for yourself. Have a great day.